I'm Tom Dalton. Have you been wondering how substantial economic effect works in a partnership? If so, then maybe I can help. In this video, let's take a look at the basic idea of substantial economic effect. Let's start with a brief overview of how substantial economic effect fits into the grand scheme of life. Everything starts with IRC Section 704. Section 704A states that the partnership agreement will control allocations of profit and losses among the partners. That's great. We have freedom in a partnership to allocate profits and losses any way we choose. And the partners can change those allocations whenever they like. But wait, not so fast. Section 704B immediately limits our unfettered freedom by declaring that all allocations must have substantial economic effect. And that topic is the subject of this video. There are other restrictions. Section 704C prevents shifting built-in gains from one partner to another. If a partner contributes property that already has a gain existing in that property, the partnership cannot shift that built-in gain to the other partners. The gain must stay with a contributing partner. Section 704D limits the deductibility of partnership losses by a partner to that partner's tax basis in the partnership interest. So, for example, if a partner's tax basis is $20,000 and the partner has allocated a $50,000 loss from the partnership, the partner can only deduct $20,000 this year. The remaining unused $30,000 loss is carried forward to future years. Section 704E limits the arbitrary dispersion of partnership losses among family members who may be in lower tax brackets. But as I said in this video, we will focus on the substantial economic effect limitation. Although IRC Section 704B states the general rule, the action immediately shifts to the Treasury regulations, where the rules are explained in detail. And right up front, we are told that profits and losses will be allocated according to the partner's interests in the partnership, unless the partnership allocations have substantial economic effect. This is scary. When the Treasury says that profits and losses will be allocated according to the partner's interests in the partnership, they mean that the IRS will allocate profits and losses any way they feel are appropriate, regardless of what the partnership agreement says, if a partnership agreement does not have substantial economic effect. So what does substantial economic effect mean? To have economic effect, the allocations must meet three conditions. I call these conditions the big three. First, all allocations of profits and losses must affect the partner's economic capital accounts in the partnership. Economic capital accounts must be stated in fair market value, not tax basis. This means that profits must increase the capital accounts, losses must decrease the capital accounts, contributions must increase the capital accounts, and distributions must decrease the capital accounts, all based on fair market value. Second, the partner's claims on the partnership assets must be based on these economic capital accounts. Stated another way, if a partnership dissolves, a partner's legal claim for distributions must be equal to that partner's fair market value capital account. Third, if a partnership dissolves and a partner has a negative fair market value capital account, that partner must be legally required to restore the negative capital account to zero. This means the partner will need to contribute cash or property to the partnership until the negative capital account is brought back to zero. This is where the money may come from to pay off any liabilities, as well as any partners who are left with positive fair market value capital accounts when the partnership liquidates. All of this must be written into the partnership agreement so that it is legally binding. If these requirements are not written into the partnership agreement, then the allocations do not have substantial economic effect, and the IRS can disregard IRC Section 704A and the partner's wishes on how to allocate profits and losses. This is not a good thing. It is very wise to have an experienced attorney draft the partnership agreement so that all of this magic wording is included in the partnership agreement. After these terms are written into the partnership agreement, it is up to the accountant to make sure that the partnership adheres to these terms. Let's see how this works. Here is an example of a partnership with 3 partners. There are 2 balance sheets, one stated at tax basis and one stated at fair market value. The fair market value balance sheet is also called the 704B balance sheet. The partnership has decided to allocate 100% of the losses to Ann. Let's assume that the partnership agreement contains each one of the big 3 conditions for economic effect. Now, assume for some crazy reason that the partnership sells the stock investments and the land for a 0 sales price. The partnership has a loss, and Ann will be allocated 100% of this loss. For tax purposes, Ann is allocated an $8,000 loss. Unfortunately, if we look at Ann's tax basis in the partnership, we see it is only $6,000. So Section 704D limits the deductibility of Ann's loss to only $6,000 this year. The remaining $2,000 is carried forward to the future when Ann may have additional tax basis in the partnership. So far, we haven't broken any rules. The tax basis balance sheet is updated for the loss, and we can see that Ann now has a negative tax capital account of $2,000. The negative capital account in this case represents the deferred $2,000 loss. Ann's inside basis in the partnership is $2,000 different than her outside basis in the partnership, which is 0. We also have to worry about the fair market value balance sheet because of substantial economic effect. In fair market value terms, there is a $20,000 loss, all of which must be allocated to Ann's economic capital account under the Big 3 rules. This is what the economic loss journal entry would look like. And this is what the economic balance sheet would look like. Notice that Ann's economic capital account is a negative $10,000. That's okay. But remember, Ann must restore this capital account to 0 if the partnership liquidates. That means Ann owes the partnership $10,000 in either cash or property if the partnership dissolves. Up to this point, the partnership has complied with the Big 3 conditions for economic effect. The partnership maintains economic capital accounts for the partners. The partnership agreement requires that distributions upon liquidation are equal to their economic capital accounts. The partnership agreement also requires Ann to restore her negative economic capital account if the partnership liquidates. If the IRS audits this partnership, they will probably agree that the special loss allocation to Ann has substantial economic effect. But what if the partners agree that if the partnership dissolves, they will evenly split any remaining assets among themselves? In that case, the economic balance sheet would probably look more like this. Although Ann received 100% of the tax loss, she did not receive 100% of the economic loss. The economic loss has been split evenly among the partners so that they each can eventually claim 1/3 of the assets. This violates the Big 3 conditions for economic effect. In this case, the IRS would probably disallow the special tax loss allocation to Ann and instead reallocate the tax losses evenly among the partners. This is the first in a series of videos describing substantial economic effect. At this point, you might be wondering how this works for a limited partner or an LLC member who does not want to be on the hook for restoring a huge negative economic capital account. That would kind of defeat the purpose of limited liability, wouldn't it? I'll talk about that in the next video. Thanks for watching. If you have any questions, feel free to send me an email. If you like this video and would like to see more, feel free to subscribe.